You think the busiest shop on your street is the one with the longest line at the register? It isn't. Somewhere on that street is a quiet store, with almost no customers, that still banks tens of thousands in cash a month, and up to $2 trillion gets washed clean this exact way every year. By the end, you'll know exactly how the trick works, which everyday businesses are built for it, and the single accounting slip that brings nearly all of them down. And right at the finish, the one tell investigators look for first. The thing that turns a successful cash business into a crime scene. There is a reason this is literally called laundering, and it traces back to one Chicago gangster and a chain of coin-operated laundromats in the 1920s. So let's follow the money. How does a store with barely any customers end up moving more cash than the bank next door, and why does it work so well? The popular story says Al Capone bought a chain of coin-operated laundromats in the 1920s in Chicago to mix dirty bootlegging cash with legitimate quarters. But historians have a tiny problem with this legend. The term money laundering did not actually appear in print until the 1973 Watergate scandal. Still, the myth survives because the underlying logic is so incredibly clean. Think about a coin laundry. Every transaction is a small, anonymous cash payment. There are no paper receipts, no invoices, and no tracking. If a washing machine runs empty, or if you claim it ran 50 times today when it actually ran 5, there's no physical inventory that disappears to prove otherwise. You just claim the quarters came from paying customers, making the cash almost impossible to trace. It is the perfect cover. But once a criminal decides to use a boring storefront to wash their cash, how do they actually move the money from a backroom duffel bag into a corporate bank account without triggering alarms? Physical cash is great because it has no name on it, but it is also heavy, flammable, and highly suspicious in duffel bags. To turn it into clean wealth, criminals rely on a classic three-step trick. The first, and by far most dangerous, step is placement. Literally shoving those paper bills into a legitimate bank. This is where the boring storefront earns its keep. It acts as the physical gateway, allowing someone to blend dirty cash into the daily register. Once the money is safely in the banking system, step 2 is layering. This is the shell game phase, where you wire the money between various accounts, transfer it across borders, or buy assets until the paper trail goes completely cold. The last step is integration, bringing the clean money back home as legitimate profit, property, or business ownership. While movies love the high-tech wire transfers of the layering phase, the everyday shop only matters at step 1, which meant the entire scheme lives or dies on placement. If you cannot get the cash past the front counter, the rest of the plan is useless. But banks are legally required to flag massive, unexplained cash deposits, so criminals must find businesses that look like they naturally deal in paper currency. Which raises the ultimate practical question: what kind of everyday operation can swallow that much raw cash without any paper trail to stop them? To swallow thousands in cash without raising eyebrows, a business needs to sell things that cannot be easily measured after the fact. If you run a clothing store, every sale requires a physical shirt to leave the rack. But if you own a car wash, a nail salon, a bar, or a parking lot, your primary product is a temporary service. There is no physical inventory, and legitimate customer cash and illicit bills become completely indistinguishable once they land in the same register drawer. A bystander cannot look at a car wash tunnel or a vending route and verify exactly how many cleanings or sodas were actually sold. This structural ambiguity is why these unremarkable storefronts, including used car dealerships, repeatedly show up in laundering schemes. The beauty is in the mundanity. But this reliance on invisible transactions eventually has to survive outside scrutiny. So how does an owner explain a sudden mountain of cash to a bank teller without triggering a quiet alarm? Instead of proving whether a quiet nail salon can earn money honestly, The real puzzle is how a nearly empty storefront deposits hundreds of thousands of dollars without anyone asking questions. This is where every cash-heavy business hits a hard legal wall. Under U.S. law, banks must file a currency transaction report, called CTR, for any cash transaction over $10,000. Walk in with $11,000 and the paper trail starts instantly. To bypass this, launderers split their cash into smaller piles, depositing $9,900 at a time to stay under the limit. This tactic is called structuring, and it is a federal crime on its own. The great irony is that trying to look invisible is exactly what creates the digital pattern. Bank software is designed to catch, turning a quiet storefront into an active target. But if the actual math of moving cash is this incredibly tight, how do real-world investigators turn simple utility bills and laundry quarters into federal convictions? If you watch television, laundering cash looks incredibly simple. In Breaking Bad, Walter White buys a car wash, and millions in drug money seamlessly vanish into the register, whether it's a fictional car wash or a mob-run pizzeria. The mundanity is strategic. Forgettable storefronts attract zero casual scrutiny. But Hollywood always skips the soul-crushing burden of tax forms, payroll, and bookkeeping. In reality, you can't just invent cash. You have to invent the soap invoices, water bills, and employee shifts to back it up. The real battleground remains ordinary paperwork, completely detached from cinematic bravado. So, when the physical reality of a shop refuses to match its faked books, how do investigators use the paper trail to dismantle the entire illusion? Forensic accountants do not look for math errors, they look for physical impossibilities. If a car wash claims it washed 10,000 cars in November, the investigator ignores the faked ledger and subpoenas the water utility. It takes about 40 gallons of water to wash a single car, which meant 10,000 washes required 400,000 gallons. But if the water bill shows the pipes only carried 10,000, the math stops working. This is the cumulative trap. An owner can falsify a stack of paper receipts, but they cannot fake the physical laws of plumbing. Bank compliance teams watch for this same lack of friction. They file suspicious activity reports, or SARS. When a quiet storefront reports perfectly round identical cash deposits every Friday, regardless of blizzards, holidays, or a completely empty parking lot. In the real world, legitimate businesses have messy, unpredictable numbers that dip when it rains. A profit line that looks too clean is almost always a lie, because the building itself has physical limits. But if the physical reality is this easy to cross-reference, how much of this shadow economy still manages to slip through undetected? The United Nations estimates that criminals clean between 2 and 5% of total global GDP every year. That is roughly $800 billion to $2 trillion slipping through the system, of which authorities recover less than a tiny fraction of a percent. This massive scale is why those boring street-level operations matter. A global shadow economy has to start with small, local gateways. The trillions eventually flow back to the real world, hiding in the cash drawers of the sleepiest shops on your street. But when you walk past these quiet storefronts, how do you tell a struggling neighborhood business from an international front? Today, the ultimate criminal disguise is not a complex shell company, it is a lonely laundromat. As long as physical cash exists, the brilliant simplicity of the boring storefront endures. It is tough to bust a business for being too successful. What is the quietest shop on your block? Let us know below.